they're saying anything deposits over 250,000 is protected, which is a really dangerous thing, to be honest. There isn't FDIC insurance dollars available from the FDIC itself to cover all the losses. The money's not there, right? So at that point, essentially, really, if the DIF goes down, the FDIC no longer can insure all deposits. So, like, just as we've been recording this, like over the last hour, like Credit Suisse, it was reported their stock was going down.
Welcome to the show. My name is Luke Broyles. Hopefully, a lot of you know who I am already. I am here today with Jason. Jason, thank you for joining me. As you just said before we started the call, let's skip the chit chat and let's just get to it because there's a lot to talk about. So thank you, Jason, for joining. Appreciate it.
Sure.
Yeah.
Happy to be
So
here.
yeah, thank you. So there's a lot I think we could agree upon and we would agree upon. I think there's a lot we would disagree upon. And I think within each of our respective circles, me with, Bitcoin and all that, and you with, the FDIC background and everything of that sort, I would just love, first of all, to hear a little bit of your background, because I'm sure most people may not know what your background is, what your titles were, and what that even means. So if you could just give a quick little synopsis of what your background was as a regulator in the Great Financial Crisis, that'd be wonderful.
Yeah, sure. I'm an ex regulator at the FDIC. So I worked at the FDIC in 2018. 2008, where I helped with capital markets and finance issues relating to IndyMac Bank, the failure of Merrill Lynch, going to Bank of America, AIG failure, Washington Mutual, Wachovia. So I help with all of those sort of as from the regulatory point of view with some of the sales, purchase and acquisitions, evaluating like how to deal with the IndyMac Bank run itself, where I supported the board at the time, which was from the government. And then I went on to be an FDIC examiner for a few years after that in DC and also out in the field. So I've done a lot of consumer compliance exams as well as safety and soundness. And then in 2011, I started doing some consulting for the Treasury's HAMP program, which was helping people stay in their homes with like a low interest rate, long amount of years in a mortgage for a few years. And then I'm actually got into our space for Bitcoin and blockchain in 2016. So I am a Bitcoiner. I've been actually got transformed into one during the financial crisis in 08, even though Bitcoin didn't exist. And I worked for the Chamber of Digital Commerce for a year, doing policy on international, state, and federal. And then I worked for a while with Consensus, Joe Lubin and Ethereum as their head of government affairs. Now I do my own private consulting. One of the areas I'm helping with is I'm an advisor to the Bitcoin Policy Institute, or BPI, run by David Zell.
But that's quite the background. I find that fascinating because typically people are either entirely one camp or entirely the other camp, and you've more or less crossed that bridge, and so you see both sides, which I think is perhaps very rare. So, but before we get to crossing that bridge, before we get to Bitcoin, I'd like to talk about first diving a little deeper into 2008 and what you saw, and a little peek into what most of the public may not be aware of, and then maybe we can compare and contrast that with the events that are unfolding in the last week or so here in mid-March of 2023. So could you touch on a couple of things of 2008 that we may not be aware of? I would really like to hear your thoughts on AIG. I would like to hear your thoughts on Dodd and TARP and everything else of that sort. If you just have any passing thoughts on that.
Yeah, so I mean, the '08 crisis, when you're talking about AIG, that was a real turning point in the crisis because the day before, Lehman Brothers had been allowed to fail. So if you're kind of, looking at the markets and think if a bank or any kind of business goes bust, it goes bust. But the problem with AIG related to the derivative exposure it had to all the different banks. And so with that amount of notional derivatives, plus you had a lot of people short selling bank stocks in the market and longing credit default swaps. So they were doing this dual trade that drove Citi almost to the below $1 a share until the SEC actually intervened and halted short trading of financial stocks, which is pretty incredible. But AIG was really the case that kind of the people a lot of times in our industry now with Bitcoin think about Gary Gensler. Gary Gensler went over to the CFTC and set up a way for them to regulate the derivatives market because the regulators like me and others just didn't have the insights into what was happening. And so that was a major crisis, obviously involving, like you said, TARP, bank money that was put into all the banks. There was a question of whether Wells Fargo would take the money, and that relates a lot to kind of with Silicon Valley Bank that we have now, which is a bit of a problem. So Wells was like, hey, this crisis isn't our problem in 2008. Why do we have to take all this taxpayer money? But the problem was that if Wells didn't take the money, what JP Morgan Chase and Bank of America did, everyone think there's something wrong with JP Morgan and Bank of America. I better go put my money in Wells. So everyone had to take it. What we see now with Silicon Valley Bank is the scenario where we're saying we really created 3 tiers of banking now. We have the large banks that can't fail, like Bank of America. But at the top of that, where your money's even safer, is now at Silicon Valley, because they're saying anything deposits over 250,000 is protected, which is a really dangerous thing, to be honest, because there's something a lot of people don't know with the TARP, which was the FDIC. We did our own program called the TGLP, which was the Transaction Guarantee Liquidity Program. And that was to guarantee people's deposits, ad infinitum. So this real dangerous thing that probably, for you probably is thinking like money printer goes burr big time, because we're making all these promises about large amounts of deposits that are protected in banks. But I will say that the ultimate solution that the regulators came up with, which is really not much different than 2008. So fast forward 15 years, there really isn't a lot new tools that they have to deal with these crises, is to essentially buy the bank and try to have it run by the government and then sell it to another buyer. And that's really what Silicon Valley Bank is today. It's similar to IndyMac Bank, which is called a bridge bank. And people remember former Secretary of Treasury Steve Mnuchin and Brian Brooks, who was the OCC comptroller. They both were involved with One West Bank, and One West was the eventual buyer of IndyMac Bank. So they want to bring it out of the government back into the private sector.
That seems like it's difficult, though, bringing it back in the private sector. I mean, again, leaping forward back here to 2023 with Silicon Valley Bank, pretty much what they were doing entirely that did them under was they were just buying treasuries, and the treasuries lost their value in Silicon Valley Bank. Even though they were private, they went under, and now it's shifted back. It's like a pendulum that swings back and forth, and the gyrations get more and more volatile. I don't know how you think about the future of banking and where this is heading, but when I compare what has just happened, compare 2008, in my uneducated view, compared to yours, what I see is a real problem, because what the Fed is basically doing is they're guaranteeing these losses on the bonds, more or less. And then to your point about the danger of the FDIC going over the 250K, I mean, my question for you is the FDIC. So the FDIC already only has about a 1.2% reserve ratio. So $9,900 billion, $9.9 trillion of secured deposits, and 130 billion of reserves, which I suppose that's less now because of Silicon Valley Bank. So my question, just as a person, is what happens when that 1% reserve is gone? And now that we've set the precedent of just going over the 250,000 limit when it was convenient in that one instance, is that setting the stage for something more dramatic? Or do you think that is generally just a one-off? Or what are the potential paths forward there, both in terms of danger as well as in how on earth can we get back to normal after what's just happened?
I'm so grateful that you asked that question. And in a sense, I'm almost grateful all of this is happening. So I had the same exact thoughts that you did back in 2008. But at the time, there wasn't really a Bitcoin community or where people actually talked about criticizing the Fed. It was really Ron Paul and your own kind of internal thoughts. And back in 2008, I was a junior analyst in the capital markets group at FDIC, but I started asking myself that question. Well, what does happen if we exceed the 1%? And this is where I started going to the rabbit hole of realizing there isn't FDIC insurance dollars available from the FDIC itself to cover all the losses. And I had to remind myself it's an insurance company, right? An auto company doesn't have, all the money for all the accidents if everyone had an accident at the same time. So that's where there's this element, right, of trust, of realizing that it's most important what happens with the public trusting the banks. And that's where I think the Bitcoin narrative started way back when, because people started losing faith in 2008. They saw a crack in the system. So to your point, though, about what technically happens, I think the Treasury has, I think the FDIC has like a line of credit or something, maybe to the number of, I don't know what the number is today. Maybe let's say it's 5 billion or something that they could dip into if ever the FDIC fund goes negative. And the FDIC fund did go negative. And so it's either a facility at the Fed that supports them, that money, or it's taxpayer money, because the money's not there, right? So at that point, essentially, really, if the DIF goes down, the FDIC no longer can insure all deposits. And that's what I'd say is most interesting right now. Again, hearing all of you talk about it, like when I say all of you, I mean all the younger people who are like having these same questions I had 15 years ago. It's really exciting because I don't feel so alone anymore. But it kind of makes you beg the question of, well, what are we trusting exactly? That the bank exists? Are we trusting the dollar? And this is where, for me, my sort of Bitcoin story started, because I said, well, I want some kind of money I can actually trust. Now, institutions a different thing, right? Institutions come and go. FTX came and went. Some banks come and go, like Lehman Brothers. But what about the money that you're holding, and what is protecting that money? And at the end of the day, the U.S. government has a lot of debt. So the sort of the unspoken truth is that we don't have all the money that is in the bank, that is our liabilities of the bank, is not covered by the United States government. It's backed by the full faith and credit of, but not covered by insurance.
Yeah, I've only done it a couple of times now, but on Twitter, whenever I go to the bank, I take a picture of the FDIC logo just to emphasize that point, what you just said, that it's by definition literally on the sign, full faith and credit in the United States government, and that works, and it's wonderful, and it's the most trustworthy government in the world, I suppose, until suddenly, what if there's a question to that faith and credit? So I liked what you said a moment ago about how it just comes down to trust and what really backs that system. And something I would like to add to that is I think it just comes down to the faith in the future scarcity or abundance of the underlying currency. Like, I think it is faith in the banking system, but I think it's also faith that the money itself is not infinite in nature. I don't know if you heard me on my other shows, but basically I talk about that in comparing Bitcoin to everything else, obviously. But to me, it seems that if I'm going to compare the trustworthiness or the degree to which one should trust a form of money, a large part of it comes down to the function of how scarce or how abundant that currency is. And the farther into the future you can predict that, the more worthy of trust that currency is. And at least to me, I love to hear your thoughts on this, whether you agree or disagree. To me, Bitcoin seems to be unique because it is the only form of money that is worthy of trust, in my opinion, because it doesn't require trust, because it can have verification and it doesn't have the regulation oversight by humans. I believe that if you can have a form of money that can be corrupted by humans, it inevitably will be, because no matter how much oversight you have a certain incentive that grows as the value of that network grows. And so anyway, I'd love to hear your thoughts on that of does that amount of scarcity or abundance, is that a critical component of the trust of that form of money? And if it is, how does it interact with Bitcoin? And how does that now interact with the US dollar, now that we have more or less eliminated, or at least put it in a quasi state, the 250,000 cap, and basically have basically the Fed backstopping all these bonds on par? I mean, anyway, I just love to hear your thoughts on that dynamic there between those.
Yeah, I think that, well, first of all, you see the back of my wall in my office, and my entire office is painted orange, by the way. So you know how I feel about Bitcoin. The question is, what has the best potential outcome? And in my mind, Bitcoin has the best potential outcome as a hard source of money that you can't really mess with, that I know, similar to sort of the way gold used to be viewed, you know? And what I think though is the problem, like for me though, I do cold storage with Ledger or you know, things like that, is where do you put it, right? How do you store it safely? You know, I do the Ledger, I do the self-sovereign thing, but ideally, I'd rather have some kind of third party that I can trust to store my Bitcoin. You know, that's me. It's probably where we might have different opinions on it. And I think if you look at sort of what happened with gold, you know, there's two things that are really bringing us to 2023 that are really impacting us. One, I don't think this is necessarily like a new crisis. I think this is an ongoing from the 2008 crisis, right? Because we had 15 years of this very low interest rate. And this isn't the first time that this has happened. Like, we've come out of financial crises before, and I can tell you, I've read it in the FDIC history books. Banks tend to fail because of interest rate risk. When we have a low environment, we move to a high environment. So this is not anything new. And hopefully Silicon Valley Bank was the only one that kind of went out for this long duration stuff. But what I think we're starting to realize is we changed a long time ago the decision to put the US dollar not backed by gold anymore, and backed by really the decision-making points of the Federal Reserve as to what monetary policy should be. So you have these people now who are really like appointed to determine, you know, how to best keep the dollar as a quote unquote medium of exchange, but also as a unit of account and a store of value. And, you know, there's this issue of, do we have to support everyone's dollars that's in the bank? Because a lot of people, and this confuses me, but maybe not you, but like over the weekend, I think it's baffling how you have all these tech companies who are saying, well, we had all of our dollars in the bank, like 1 million, so it should just all be protected, right? Because it's the bank, like it's our cash. It's like, well, guess what? A lot of people had Bitcoin, and then FTX went away, and you don't have that Bitcoin anymore. So is it going to be, it's almost like, is the ledger going to be on the balance sheet that you're going to trust? Or are you going to find a way to do cold storage where, like, I have the private key maybe, but it's backed up somewhere by someone else I can trust in terms of, and that's really where I think we are with the argument. To me, the dollar is I don't see how they could peg it to anything else. And I think that they're still trying to figure out, they're using the same solution to now that they did in 2008, which is create these Fed facilities, credit facilities, but that's what led us to this problem of an inflated balance sheet of the Fed. And at some point or another, it needs to be retracted. The question is, when are they going to stop using all these Band-Aids to realize there's a real, you know, the patients on the table bleeding out in ER?
Now, I fully agree with that. I fully agree that basically the solution is the problem of the next crisis, and the solution of that crisis is basically the Band-Aid that is the problem for the next one. And so, like, I'm looking at this right now, and thankfully it's you know, mid-March right now. It's not as bad as 2008 yet, and hopefully it won't be. But you know, my question is like, okay, if what we've just done is create a more perfect storm in the future, because now we've set multiple precedents that are brand new, and yeah, it's it's pretty baffling. And I like too that you're bringing up FTX. You brought it up a couple of times now. Could you just comment on that? Because I remember when I was trying to warn people to get out of FTX when it started, you know, looking shaky and getting really, really sketchy. Unfortunately, it wasn't on Twitter or public on Twitter at that time. But could you comment a little bit on that for perhaps people that are watching that maybe don't understand the difference between fractional reserve and full reserve banking, or perhaps more accurately, fractional reserve and full reserve ledgers? Like, could you explain that difference and why FTX, at least in my view, perhaps you disagree, why FTX is basically identical to the rest of traditional finance banking, and how Bitcoin, even though they're both crypto, are very different? Do you mind touching on that?
Yeah, so, you know, that's a great point, because let me start with Circle for a minute to help. So Circle with USDC, Circle had a lot of money in Silicon Valley Bank that failed. So what does that mean? That means against their stable coin, they had dollars in the bank. Those are deposit dollars, just like if you or I deposited some money at our local bank. That money doesn't just sit there, right? The fractional reserve part comes because then the bank takes the money they need the deposits because they're based on how much money they can make off of their assets. Well, what's an asset to a bank? It's your loans. So they take the money to make loans. And so the money isn't just sitting there. Now, FTX is actually worse than traditional banks because FTX touted itself as a full reserve bank, meaning you put your Bitcoin on there and they would custody it for you. And then if you needed it, you could get it back. Now, in some instances, they did a lot of margin trading, and that's where people use leverage. And that's really those people's decisions that they're leveraging. So meaning if you don't get that Bitcoin back that you leveraged, I'm not really going to have a lot of empathy for you. You know, if you wrap Bitcoin, now you can't get it back. That's your decision. But if you just put a Bitcoin in FTX, they said it was full reserve backed, meaning you should be able to get that Bitcoin out, whether or not the institution fails. It turns out it really is the worst of all worlds because they were actually taking that money, just like a regular bank was, and using it to fund an affiliate's investments, Alameda, which, to be honest, in traditional banking would almost never happen because there are things like Reg O and Reg W that prevent insider trading and the like, and the relations you have to affiliates. So as opposed to Circle putting money in a bank where you know those dollars are going to be lent out, people put their money in FTX thinking that it's there when they want to pull it back. But the truth is, as we've now learned, is that sometimes the exchanges will have their own ledger, but they still should be protecting your Bitcoin or have enough Bitcoin to cover what they you put in the quote unquote bank. And that's really where, to be honest, it's so interesting you bring that up because today that's where Congress really is at, right? In terms of determining not just stablecoin legislation, but centralized exchange legislation. You know, how do we make them be quote unquote proper custodians and have that trustworthiness? And that's in large part no thanks to Sam Bankman-Fried, who also was apparently doing a lot of criminal activities too. So it just became the worst of all worlds.
Yeah, that's that's quite the bleak picture. To me, it sounds like that this perhaps is more of a speculation, but to me it sounds like, from of course everything I read before and pretty much what you just said, it seems like people are disenfranchised or feel disenfranchised with the current banking system, and more or less in an act of desperation are looking for alternates. And some people go to gold, some people go to silver, some people go to this or that or whatever. And it seems that some people are going to these exchanges and these other basically unregulated banks, more or less. They're actually worse than banks because they're not regulated, because they don't have people like you having the oversight, it seems. And so it seems to me that basically FTX and this whole exchange debacle of the last couple of years, and perhaps still ongoing today, is basically like an offshoot, like a perverted and distorted offshoot of basically what already exists, where it's like fractional reserve on steroids, and it's already, already it seems tight enough, and the way the world is today in the regulatory space. So do you see that in that light, or do you think that it's, or do you think it's different than that? Because to me, I see it more as an offshoot of the traditional space, and then Bitcoin is something separate. But perhaps you don't see it that way, or you would put it a different way.
Well, I think that's where, and actually, this is just talking to you now, I'm thinking through this. It's about the asset, right? The money, what we choose. Are you going to choose a US dollar or a Bitcoin? And then it's about the institution that you're doing business with, right? So dollars on its own without no backing, most people don't keep all of their savings in cash who are serious about retirement, because they all know there's a ticking time bomb on your dollar that it's going to go to zero at some point or go very low. You're not going to be able to spend a dollar what you do today that you will 20 years from retirement. So you just don't leave it all in cash, right? You also don't do that because you don't want someone robbing you and then suddenly you don't have any money. So that's where the convenience of a bank comes in. Go to the bank and you could put your money in a vault, in cash, or you could open up an account. Most people just open up an account because that's their deposit account, and they assume that that money is theirs and is mostly protected. As you said, people see that sign of FDIC. Hopefully they read it once in a while and say, oh, $250,000. So maybe if I'm putting $500,000 in, there's ways to make sure you're fully insured if you're a family, by the way. I mean, just like if you have, let's say you have a spouse, you open up a joint account with your spouse, that's 500,000. You're each covered at 250. Open up an account in your name, that's 250. Open an account in your wife's name, that's another 250. there you go. You have $1 million of coverage of FDIC. So there's ways to, be an informed consumer. But I guess what I'm saying is Bitcoin is different because you can bring your Bitcoin to, a bank like Anchorage Digital Bank and have it stored there, or FTX or anywhere else. But Bitcoin, I don't know about you, but for me, I don't mind having it on my ledger or off because I feel like it's going to continue to grow in value. It's not going to decline in value. So that's the asset. So Bitcoin definitely is different and has nothing to do with the institutions that are a crisis. What I agree with is, yeah, FTX is an offshoot of the banking system, but it was sort of this, like you say, kind of on steroids, because it was like Bernie Madoff running Citigroup. It was just got really, really bad. And so the unfortunate aspect of that is you now have a lot of people in Congress who don't separate Bitcoin from the other stuff, right?
Yeah, and not just in conference, but in general too. When FTX first collapsed, I cannot tell you how many people commented at me or came up to me or like, I hope you didn't buy Bitcoin. I hope you sold your Bitcoin, or you still talk about that. And anyway, it seems to me that most people look at terms face value and they don't question the underlying math behind it or the underlying reserves behind it or how the system works. So anyway, sorry, I interrupted you, but yeah, I think it's not just Congress.
Yeah, no, absolutely. No, I mean, that was the point I would make. Interestingly, where there is a danger to Bitcoin, that is maybe where we disagree, but I think there is a danger because Bitcoin is still quote unquote pegged to the US dollar. That's the way people figure out for the most part how much their Bitcoin is worth. They don't go, okay, one Bitcoin is one Bitcoin. We're not, maybe some people do, but the vast majority, I think, of people buying Bitcoin say, well, how many US dollars is it equivalent to? And so I say that to say not you shouldn't be pegging it or not, but the truth is, how do you buy Bitcoin today? If you're just starting out, you probably have a bank account, you probably have some cash, maybe you have some stocks and bonds. So this whole, like, we've heard this name operation, choke point 2.0. But I don't know that necessarily the choke point's the right word, but if they shut off the on-ramps for people to buy Bitcoin because the banks say, you need to stay with us, first of all, like in any other industry, you and I would be like, well, that's monopolistic behavior. They can't do that. So what we really need to try to honor and push for Congress to try to do is to say, people should have a choice. You should have a choice to go buy Bitcoin with your money. So banks should allow that. They shouldn't kick your account out if you're somehow have Bitcoin as well. And I think a lot of it is just a lot of misunderstanding and fear on the part of the banks, the traditional banks, as to what's going to happen. I mean, it's not said very often, but like, Jamie Dimon, like of Citi, most of his portfolio is in digital assets. And a lot of people don't know that, but he speaks out against it because for his bank, he wants people to trust, the safe banking dollars. But yeah, this is a really interesting discussion. And I think it really is about that. It's about the asset, US dollar versus Bitcoin. And then what institution are you going to go to? Are you going to go to Ledger? Are you going to go to Trezor, whatever kind of cold storage option? Or are you going to try to trust an institution? And people should understand if you're going to try to trust an institution, whether it's FTX or someone else. And I don't know that we really have a way to decide yet. Do you, as to what exchange is good or not? I mean, it's hard. I mean, Swan's good, right? Because they're Bitcoin only. That's a positive thing. But at the end of the day, you either custody it yourself to be perfectly safe with Bitcoin, which I agree is different. It's just, and I'll give you this example of in Congress, and this was told by Grant McCarthy from Bitcoin Policy Institute. He was explaining what Bitcoin was to someone, and they were asked, well, how is that different from the FTT token that Sam Bankman-Fried had, right? So that's how quickly they are to just push all this stuff together, So there's a lot of education that still needs to happen. And I hate saying that, like education, but it really is, because it's a complicated subject. I don't know about you, but it took me a long time to understand Bitcoin. So for someone that has maybe 5 minutes a day that hears a pitch about it, that's not enough time. So we got to find a way to get more time for, our congressional and regulatory folks to actually understand what Bitcoin is.
Yeah, you said so much excellent stuff there. I could just go on about that for a long time. But yeah, regarding education, I think for every amount of education people need of new information, I think they need like 5 times as much unlearning what they know. And that's not saying that, oh, you're wrong and you just have to be smarter and learn. That's just to say that I don't know about you, but I think our brains have been trained to assume certain things that are not particularly true. And I think one interesting point is what you said about the peg of the dollar to Bitcoin. And I think that's true. I think that's a concern, but I think largely that's a psychological thing. I think we peg it to the dollar because we peg the dollar with value. And our brains are just so used to assuming that the dollar equals value because our brains reinforce that behavior 100 times a day when we exchange anything for the dollar. We peg everything that we value against the dollar, and we have for our whole lives. And so trying to understand how Bitcoin depegs the dollar against everything else, and already has, I would argue, and is continuing to. I think as much as people need to learn about Bitcoin, I think they need to unlearn truths that they, or things that they took for truths that actually were just assumptions. And I talk about this a lot with technology, and I think that's a lot of why people have enjoyed hearing my perspectives. But anyway, enough of that. But it's fascinating from a regulatory standpoint that. But yeah, comparing FTT token versus Bitcoin, I've had that too. I've had a lot of people reach out to me that are either financial advisors or bankers and are just happy that I'm drawing that distinction between them because either they feel they can't or they're told they can't because they have obligations and responsibilities and everything of that sort that they're not allowed to talk about it. So why are you allowed to talk about
Luke,
this?
sorry, can I ask you just so along those lines,
Yeah.
though, the technological side is,
Mhm.
so my question would be like, and I think we have to give ourselves a break because we're 15 years in on Bitcoin. Imagine if we were there when we found gold, like, well, this should be valuable, but how valuable is it? Do we weigh it? How do we consider
Yeah.
it? Do we use gold coins? So I think that's really where you're at, and you're onto something there with what's the next book or rabbit hole or explainer that's going to explain how Bitcoin is intrinsically value without saying this is following what, well, it was good in 2017 because it went up against the US dollar. You know, at some point, when are we going to say, look, Bitcoin is this truly special thing, and this is how you can consider its value without using what we're, as you say, all trained to do.
Mm-hmm. Yeah. Yeah. Well, fascinating. I have a couple more questions. One of those is, what is your biggest disagreement with the more, I don't know, mainstream is the word, but obviously you're coming from a different perspective. I know there's probably a lot of people that would disagree coming at Bitcoin from the route you are from within the current paradigm. Um, what's your biggest disagreement? I don't know what it is. I'm curious what it is and why you think that.
I think that my disagreement is that we need to be willing to be a little more flexible. And like I tell my friends in governments to close their ears when I say this, but to, dare I say, almost be a little bit like El Salvador, right? Because El Salvador has Bitcoin and the US dollar. They have both. Now, I'm not saying make Bitcoin legal tender. I actually think that's a mistake. But I think to the degree that we can say Bitcoin can be part of our society and our culture and add value, particularly with the notion that the US dollar may not be as perfect today, or excuse me, 20 years from now, that will today, is we should keep our options open. We should be welcoming Bitcoin into the banking system. You know, custody should be something people can do at their banks. And if we want to really be a successful country in the future, you know, on a technological level, I think it makes sense to get people acquainted to, as opposed to preventing them from using Bitcoin. I think you're on mute.
I'm sorry. Sorry. I was just saying that I think that's interesting that basically you're saying be more open-minded. And I wonder if that's frankly, I wonder if that's possible. Do you think that's possible? Because my concern is, like if again comparing this to technology, if I'm a newspaper company in the late 90s, early 2000s, whatever, and this internet thing comes about, I have a very strong incentive to disregard it and ignore it and push it aside. And like we were saying earlier about Jamie Dimon and people that are, we wonder why the people that are financially incentivized by the survival of the banking system are so resistant against something that poses any kind of threat, or not even threat, but just alternate to that. And anyway, so do you think it's even possible to get to that point? Because I like what you said about being more open-minded. But do you think it's possible for a for two competing technological systems to do when they're in more or less a zero-sum game, which is basically what monetary systems are always in? Like, do you think it's possible?
Really say,
Now you're on mute.
I'd say it's truthfully, yeah. Truthfully, it's unlikely. That's how good the conversation is, right? We see what one someone says and we want to just respond right away. It's unlikely, but I hope there's some room for it. I mean, there has to be the problem we have now. If you're sitting in Congress and you're concerned about national security, which is why I think lately the other Jason Lowery's software book has gotten so much coverage, is because we use dollars for sanctions purposes, right? We rely on the strength of the dollar, so we don't have to send young men and women in the armed forces to die in a country. That has a lot of negative consequences. Obviously, the humanitarian side of the people who are victim to a dictator that they have no control over, but it's a choice that we make as a society. So our fellow Americans don't die in a battle on the ground because we can avoid it by imposing economic sanctions. That I would say is the biggest hurdle and probably prevents what I'm talking about.
Yeah, just the game theory there I find fascinating, and then only more terrifying the more I think about it, just because it is so strongly incentivized to being for competitors, but it's not competition in a destructive way. And I think that's what Jason Lowery, I don't know your full opinions of his work, but that's what I find interesting about his view, is that basically Bitcoin is like a form of global 27 war, more or less, for lack of a better term, again thinking from a militaristic standpoint. But instead of mutually assured destruction, it's mutually assured cooperation or mutually assured preservation. And then that goes back to Nikola Tesla's idea about Bitcoin. That's a whole fascinating subject too. Well, I have one more question. You are a regulator. You're a regulator in the FDIC, or at least former regulator. Yes, formally, yes. Thank you. And you've seen risk happen. And so my question is, from a risk standpoint, what do you think the lowest risk things in the world today are? We've seen what's happened with the FDIC upping their secure deposit limit, kind of quasi. We've seen the Federal Reserve basically, have all these bonds, basically putting them on par with their formal values. And anyway, considering all that's happened in the last week, and considering where we think the world potentially is going in either a USD and BTC plural world, or perhaps a BTC only world, no matter which way we're going, accounting for all the probabilities and accounting for risk, especially on the insurance perspective, again, considering AIG and FDIC and all that, what do you think, where do you think the risks lie? Where do you think they lie? And how do you think that the average person watching this can mitigate that risk to the best of their ability?
Wow, that's I would say I'm not sure what the risk is in the banking system, because we clearly had subprime mortgages in 08. So I don't know what might be driving other banks to the point that people are starting to get worried about the confidence. What I'd say where the risk lies, I think, right now in the system is with stocks. So like, just as we've been recording this, like over the last hour, like Credit Suisse, it was reported their stock was going down. Regulators met with them and now the stock is rebounding. And so what this signals to me that this is happening so fast right now is that we are in the midst of the beginning of what could be a financial crisis. So my prediction would be what you could potentially expect is a large part of the pressure on these stocks are short sellers, people seeing the opportunity to make money if a bank goes short. And one of the things we did in 2008, well, I didn't do, but was done by the SEC, was they halted and stopped allowing short sales on financial stocks across the board, which sounds pretty crazy, but it happened just 15 years ago. So, I mean, I think you could maybe expect that as a possibility. This is not financial advice. I'm not saying to go buy bank stocks because they'll go ahead and get all the shorts off your back. What I would say, I think this is really something for everyone to think about. This is, again, not financial advice, but if you have $250,000 in deposits at the bank, that's FDIC insured. but don't bet that the rest of it is protected. That isn't necessarily the case. And what I would say is take that money and put it into Bitcoin, put it into, if you like, gold or something else or whatever, but diversify the way you hold your deposits. A lot of times we think like wealth management is just for the rich, diversify what mutual funds you have some at, Merrill Lynch, some at Morgan Stanley, some at Goldman Sachs. Well, start thinking that same way with your family's wealth. Maybe you worked 40 years, you're getting ready to retire and you have $3 million. Think how you can maximize your FDIC insurance coverage. And even though it may be inconvenient, put that money in 3 or 4 different banks. So, to again, maximize your FDIC insurance coverage. That's the most basic, key play I would say would be for families to take right now and small businesses.
Well, what about long term though? Since its reserve ratio is under 1.5%, if say if someone's watching this and they have $250,000, $500,000, $1 million in FDIC, how much of that money is really there?
I mean, it's backed by the full faith and credit, like we were saying. So it would involve some extraordinary measures. Remember in the '08 crisis, the FDIC, the diff went negative for a while, and there were ways that they had to counteract that to cover it. And I hate saying it this way, but if we get to a point where it's beyond that, where like 10 or 20% of all the deposits in the system have to be covered by deposit insurance, I mean, that's when like the zombies have come out and we have really serious problems in the world. So hopefully we don't ever get to that point. But you're right. It remains a challenge. I personally think at least nothing's changed from 2008 to now, where most people, not necessarily exposed to Bitcoin or not, do believe that, do believe in the FDIC and do believe that at least what is said will be covered is insured. And FDIC has held its promise since 1933. So it's one thing that's worked, whether or not you consider it a moral hazard or not. It is a problem, by the way, though, I will say, to finish up on this, is if we do decide to insure all the deposits, right, we just take that 250,000 lid off, we already feel there's a moral hazard because bankers kind of know that 250,000 is protected by the full faith and credit. So they take all kinds of risks. Imagine the risks that bankers would start to take if they knew all of the money that they got was all from the good faith and credit. That's a moral hazard of I can't even measure that amount of moral hazard. That'd be pretty dangerous. We'd be giving the bankers a lot. We already give a lot of the large bankers. We're all dependent on a little bit of how they act in terms of risk. Because like if a Wells Fargo or Bank of America went down, it'd probably affect the whole economy. But then you're talking about just an uber amount of trust that we then have to place in these corporate bankers.
Yeah, that would be quite the ironic twist of fate, that by expanding the sphere of faith and credit, you ultimately undermine the quality of that potentially. That's a very interesting thought. Well, thank you very much for joining me. It's been very interesting hearing your thoughts. I really appreciate your time and hearing your perspectives. So thanks. You're on Twitter, and where else can people find you?
Twitter's the best place. DM me
Twitter's
there.
the best place.
Yeah, I would say just go to Twitter. So
yeah. All right. Well, thank you very much. Thanks for joining me.
Thank you.